Hi there, everybody. So today I want to talk to you about tax credits and state incentives, specifically Pennsylvania, since that's where I live. I know more about that than what you might get in other places. There's a lot of misinformation about the tax credit, and I have to say that it seems like a lot of that misinformation is being spread by what we would call EV evangelists or company websites that are selling EVs, and that includes Tesla. The $7,500 tax credit is not a check from the government for $7,500 to thank you for buying your Tesla Model 3 or your Tesla Model S. A lot of people think that's what it is, and that's actually not what it is. So I'm going to try and talk to you in some very plain spoken English, because I'm very plain, and kind of put some perspective on that so you understand what it is that we're talking about. First of all, the disclaimers. I am not an investment guru. I am not a tax attorney. I am not an accountant. I'm not any of those things. So you should do your own research to make sure you understand what's really going on here. But that being said, the main thing you want to look at when you're evaluating whether or not the math makes sense for you to buy an electric car, and I am a firm believer in that the math has to actually make sense. There's a lot of things you can do as a lifestyle choice. Right now it seems that putting solar on the roof, at least in Pennsylvania, is largely a lifestyle choice. But I believe fundamentally it needs to come down to compelling math, or else we're never going to have widespread change, because people are practical, fundamentally speaking. And that goes maybe less applicable toward cars, because people tend to let their emotions, dictate a little bit more what they buy car-wise. And I think that's okay if you have the means to back it up. But it needs to be something that the math works. So for those of you who are confused by the federal tax credit, or are assuming that you get this big fat check from Uncle Sam, that's generally not how it's going to work. What the tax credit is it is a $7,500 reduction of your tax liability. That means that all of the taxes you pay during the year, through your company's withholding, or if you're self-employed, you're making those quarterly tax payments, all that money, when you file your return, there's the total tax liability, not just the tax due with the return, because sometimes that's a refund if your withholding's a little bit out of whack. In fact, I think for many people it's a refund, because people like to give that interest-free loan to the government. But if you hit it dead on, then way to go. But for most people, it's probably a small refund or some kind of refund, and that's okay. That's better than, I think, having penalties if you're not able to estimate your taxes properly. But for the majority of people, they're having withholding done by their company, and they're going to end up with some amount of refund. What you want to do is look on your tax form where it says liability. That number needs to be $7,500 or more in order for you to get the full tax credit. You cannot get a refund from taxes you didn't pay. So if you have a tax liability of $5,000, you will not get a $7,500 tax credit on your new Tesla or Leaf or whatever it happens to be. You will get a $5,000 credit on that car. That's really about as simple as it can be. Now, having said that, what does it take to get that liability? Well, I don't know the exact math, but if you are a typical family car buyer, then there are some considerations. Is that you're going to have exemptions for your spouse, or you're going to have exemptions for children, or both, or I think in some cases even your parents or grandparents. If you're a caregiver to them, they become a dependent, so you get exemptions for them. Then there's also the standard deduction, and if you're itemizing, you may have higher itemized deductions. All of those things reduce your tax liability, so that you could be making a fairly significant amount of money and yet still not have the tax liability high enough to get the full tax credit. I see a lot of talk on forums about anybody who can't use the full credit shouldn't be buying a Tesla. And that's just ignorant. Can we just call that what it is? That's just ignorant. If you are somebody who goes into that situation and you feel that if you don't have tax liability that high, you shouldn't be buying a car that costs $50,000 or $100,000, you're ignorant, because there's a lot of ways people can make money. And there's a lot of ways to tweak their financial situation such that they can afford that car probably better than you can, because they have that much of a handle on their resources. It kind of goes back to that principle of, people that are really good at managing small things are often very good at managing bigger things. And when you have bigger things to manage, you can screw up pretty royally and maybe nobody notices. So just a little perspective there that, the richest people are not always the best with money, but there's certainly a large portion of folks that are doing kind of this elitist, classist approach that if you have to do any kind of math or juggling around to get that credit, that you are not somehow worthy of a Tesla. And I just want to just call that what it is. It's just ignorant. Those people need a wider circle of friends and a greater understanding of the different ways that families and individuals can manage their finances. There's a lot of ways to skin the cat, so to speak. Having said that, if you had to do rough math, I would guess that somewhere the breakover point is probably somewhere around for like a family of 4, a couple kids, spouse. The breakover point is probably somewhere around $100,000 to $150,000 of income is what is necessary to by itself generate the tax liability with the exemptions and all that stuff factored in to get the full use of the credit without having to do any funny business. And I say funny business, it's all legal, it's all in the tax code, but it's just extra steps. So I'm certainly not advocating anybody do anything that's not legal. If you're making less than that, you can still get the full tax credit. You just may have to do some additional steps to take care of that. So a couple considerations. The easiest thing to do would be, okay, I'll just increase my tax liability. Let's say my tax liability is $5,000. I need to do something to bring up my tax liability so that it's $7,500, and that's how I will get the full use of the tax credit. Yeah, that's basically all you have to do. It really is that simple. But there are some things you can do easily and some things that are harder to do. For people like me, I have a regular job. I can't necessarily work enough overtime that I could just generate that much more tax liability. And I don't think I'd necessarily want to. I don't really enjoy working a lot of extra hours like that, especially when it's just to raise my taxes. That doesn't seem like a real good approach. So one of the easiest things to do if you are in a position where you have this as an option is if you have a traditional IRA, you can roll over a certain amount of that into a Roth IRA, and that will be taxed as income in the year that you do the rollover. That's probably the easiest way to raise your tax liability, and the only catch with that really is trying to work out the math so that you're rolling over the proper amount. You don't necessarily want to over-roll, because then you're going to end up you'll get the full tax credit, but you also have a lot of taxes to pay. If you under-roll, you may not roll over enough, and then you're going to kind of not maximize the credit, but still have gone through all these hoops to get not a full return. So the trick with that is that, unlike putting money into the IRA in the first place, if you are going to do a rollover such that it becomes tax liability, you have to complete that rollover by the end of the calendar year, not the tax year. So if you're buying a car in 2018 and you think that you might not have enough tax liability, you have to try and figure out what your tax liability is going to be before the end of the year so that you can roll over enough to raise the liability to $7,500 before the end of the year. You don't have until April. And that's sometimes hard to do because you don't always have real hard numbers on what your income and withholding and things like that are before the end of the year, because certainly you're not getting your W-2 from your employer or your 1099 or whatever it is from investment accounts, things like that. So you have to be pretty careful making those estimates to get that dead on. I would suggest doing a little bit too much because, for worst case scenario, you're going to end up with a little bit more in a Roth IRA, which is a good investment vehicle anyway. The other thing you could do, the obvious one, is if you have investments of some kind and they've been doing well, then perhaps you want to sell off some of those investments, and that would also generate a higher tax liability. And that works as well, as long as you're okay with parting with that investment. I certainly wouldn't advocate selling something you don't need to or don't want to just for the sake of paying more taxes. That's kind of not a great approach, generally speaking. You want your investment decisions to be as objective as they can be. So, but that is one way you can do it if you have something you want to get rid of anyway. Or especially if you're using the proceeds from a stock sale or an investment sale in order to pay for the car, well, that might be a win-win. There's your proceeds to pay for the car and your ability to increase your tax liability to maximize the credit. What you don't want to do necessarily is if you have a car that's scheduled to be delivered in January, you sell off those assets in the prior year, because now your asset sale, your capital gains, is in the wrong tax year from the purchase of your car. So don't make that mistake. And that may make it hard for anybody getting delivery in the first quarter of a year. And likewise, it might be something to plan around if that's how you're going to do it. The other thing I would suggest is that if you are, in a state that has income tax, and you're even thinking that there's a possibility that you don't have the income to do the $7,500 credit as a standalone thing. Oh, I should point out that credit does not carry over. If you don't use it all up in that tax year, if you don't have the liability to take advantage of the full credit, you don't get to take it again in the following year. It's not like a capital loss or something like that you can keep rolling over. That money's just gone. So that's important to note that. But the other thing you can do is if you're in that population there that thinks you might be on the edge, what you can also do is look at your state tax liability. That is your income taxes for your state. There is on Schedule B, I think it is, where you can deduct property taxes and things like that. There's property taxes and income taxes as a deduction for your state and local. It's also in there, if you read the forms, that you can do that or sales tax. Now, if you live in a state that has high sales tax, this is a no-brainer, and you've probably been doing this all along. I live in Pennsylvania. Sales tax in this area is between 6 to 7%, depending on where I buy stuff, because we're kind of north in Allegheny County. So it changes when you go up into Cranberry. But when I look at our state tax liability, the sales tax on this car alone makes it was pretty close, as I recall, for what our local income tax liability was. So for the year that we bought the Tesla, I knew this going in, and I kept track of all of the sales taxes that we paid. Everything. Every small thing. Doesn't matter what it was. We went out to eat somewhere, that was taxed, it was $2 in tax. All of it. I added all of it up. And it would be surprising to you, probably, that if you look at your state and local income taxes, how quickly and how significantly that adds up over the course of a year. I think we actually doubled it. We had some other large purchases that year, as I recall. We bought a lot of flooring for the house, for some renovations we were doing, some other construction materials, things like that. All of it taxed. So that was a fairly significant purchase. And I had a couple car repairs that were needed to be done on the old Chrysler. If you read my TeslaPittsburgh.com blog, you saw lots of laments about the Chrysler that particular year. So all of those car repairs, those are all taxed. And all of that sales tax all combined together, plus the tax on the car, made it more advantageous to do sales tax instead of income tax for the deduction. Well, obviously the catch here is that the more taxes that you deduct, the lower your tax liability is. So keep that in mind. And again, this gets into this weird thing of trying to guess, how much you might need to convert from a Roth IRA in order to maximize that federal credit. Keep that in mind, that the more you lower your tax liability, the more you have to compensate on the other side if you're doing a conversion or you're selling off stock or something like that. So it could be a double-edged sword, but generally speaking, that is something that's worth doing for anybody who's, kind of in that middle-class realm, and you're buying any car. It doesn't have to be a Tesla, but if you're buying any car that's of a significant cost, then you should go back and compare that and see how that works out with your state income tax. You may actually be close enough that if you add in all the other taxes you pay that year, like if you did a kitchen renovation in the same year, my gosh, there's another car practically, right? That's all taxed. So all those things that are taxed, all combined together, you might be able to increase that deduction. So that's the other thing I wanted to point out. Now, excuse me. When it comes to state incentives, in Pennsylvania we don't have a lot. I'm afraid that we just don't have much. But what we do have is, at the moment, a tax credit. It's a rebate, actually, that is not quite $2,000. It's just shy of $2,000. And that amount is taxable income as far as the state is concerned. So you will pay tax on it in the following year. But there are a few stipulations with income and things like that. But the benefit is, I think the car has to be under $50,000. So check your configurations on your cars. If you're doing a Model 3, for example, it may be advantageous to you not to add on an upgradable feature like autopilot or full self-driving or something like that, things that can be added later. It may make more sense for you to not buy the car with that, so that it goes underneath that $50,000 line, and that gets you the state rebate, and then of course you can add that on later. So you pay a little bit more for the option, but because the rebate is more than the price differential between buying the car with it and adding it later, you still come out ahead. Something to look into. The other advantage of the state credit is, whereas the federal credit sorry, it's a state rebate, federal credit. Whereas the $7,500 federal credit is only applicable to new cars, the Pennsylvania state rebate is applicable to used cars. There are some other, stipulations in there. I think it has to not be previously, it may not have to be previously titled in the state or something like that. I'm not sure. There's a few other hoops you have to jump through, but the general rule of thumb is that you have the potential there that even if you are buying a used car that doesn't qualify for the federal rebate anymore, the federal tax credit, you could still get the Pennsylvania state rebate. Now, it's not a lot of money, but, it's like $1,750, I think, at the moment, and it goes down over time, and it has to be renewed over time. I think the next renewal period is at the end of May 2018. So that is something to look into, is if you're looking at, do I want a Model 3 versus a Model S, you may still be able to get the state rebate on a used Model S, and they can probably be had in the right circumstances for under $50,000. So that might be a good option for you. I happen to like the Model S. Anyway, so there's a couple of the things about the tax credits and the rebates that I just wanted to kind of clarify best as I can. Certainly, I'm not an expert, but I will take any questions you have. Just put them in the comments for the video. And thank you for watching very much. And please subscribe. Bye.